Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show. Real quick before we get started here, we are finalizing all the plans for the next Inner Circle meeting. It's in Tampa, November 7th and 8th. To learn more, go check out Hard Money Mastermind, innercircle.com. All right, today we're talking income streams in private lending. There are a number of them. If you're in the game, hopefully you are taking advantage of all of these. And if you're thinking about getting in the game, you're going to want to learn some more about this. Let's dive in. You want to start?
Yeah, absolutely. So real quick, it's important to note that as a private lender or hard money lending company, you know, typically if it's your own money, that's easy, right? All the money goes to you, no problem. If you're a hard money lending operation and you're raising capital, you know, from other private capital investors, then, you know, typically there's two parties that have to get paid, and you have to figure out kind of what makes the most sense. The way that we have it set up is we typically lend out at 13 or 12.99% rate in 3 points. And then we're going to talk about some other fees and income streams here in a second. That's the purpose of the show. But, and we keep the points, and the capital investor, who's the co-lender in essence, gets 10% of the interest rate return. So if we lend out at 12.99, we're keeping 2.99 as a servicing fee, and we're servicing the loan, and the capital investor slash co-lender is getting a 10% return. So that's kind of on a broad level how that's set up. They're not getting fees, they're not getting points, not getting late fees. We're going to talk about all that here in a second. But what we found out is based on kind of the life expectancy of a loan, you know, most of our loans have a life expectancy. They're 12-month notes, but they pay off in 6-7 months. It ends up that we're splitting everything 50-50 with the capital investor co-lender. Again,
at the end of the day, how it all shakes out.
At the end of the day, again, we're not splitting with them per se, but that's where it ends up being, give or take, right? Like if the loan's outstanding, let's call it for 6 months, and you're charging a 13% interest rate, you know, effectively, you know, it's a 6.5% gross interest rate. The capital investor is getting 5%, call it, right? Because it's cut in half. It's an annualized return. So for every $100,000 that they put up, they're getting $5,000 back. And if you calculate the fees that, you know, the points, the servicing fees, stuff like that, we end up making about $5,000 as well, give or take. So that's kind of an easy way to think through that. So let's talk about fees. You want to talk about, should we start with kind of, let's talk about front end fees first.
Yeah,
so like
origination, like things that happen at settlement.
At the settlement statement. Okay. So we charge 3%, 3 points of the loan amount, right? So if it's a $100,000 loan, $3,000, we charge a $995 commitment fee. In essence, that's like commitment, funding, processing, credit repair, all kind of in one. Instead
Standard
of having
lender junk fee.
Exactly. Instead of having that all itemized.
Every lender.
Exactly. We have it as one fee. We don't get any pushback on that, which is good to know. We could probably even charge a little bit more. It's kind of nice to just be under that $1,000 price point. You know, it's, you know, 3 digits instead of 4 digits. But like institutional back lenders typically charge more than that. So anyways, that's on the settlement statement. We charge a $400 inspections, aka also like / valuation fee on the front end that has to be paid upfront before we proceed. And, you know, that gives us the ability to go out to the property, potentially either do an internal valuation, a third party evaluation. But, you know, for the most part, you know, there's a little bit of an income stream there, but we do have costs associated with that. But that's important. Make sure your borrowers are definitely paying that upfront before you're doing any, you know, real work on some of this stuff to make sure they're committed. Let me think. So
draw inspections.
So we have draw inspections, which are $195 per draw. Typically, we tell the borrower they can do as many draws as they want, but it's going to cost you $195 to do each one of them. We usually, based on the size of the project, we usually collect that up front. And then if there's overages on that, we'll collect that on the back end. So we don't do that on a per draw basis. So for instance, the way we have it set up, like they're not coming out of the draw. So let's say it's a $40,000 construction budget. We'll typically do 3 or 4 draws, collect for them on the HUD one up front. And that's income, goes in our operating account up front. And then if they decide they want to do, let's say, a 5th draw, we'll just charge the $195 on the back end on the HUD one. There's also the per diem interest or sometimes even prepaid interest. Again, let's say we close on whatever, we're recording this on the 5th of the month. So in this month, let's say has whatever, 30, 31 days. So let's say we have 25 days of per diem. That gets paid up front. That gets us through September 5th, all the way through September 30th. Right. So all that's paid up front. And then the first payment is actually November 1st, which covers October 1st to October 31st interest. So that per diem is obviously split pro rata with the co-lender / capital investor. If you do the math on 12.99 rate compared to a 10% rate of return to the capital investor, it ends up being like an 80-20, give or take. About that. So that's kind of an easy way to look at it. So that's for the most part the upfront fees. Sometimes we charge more. If it's a commercial deal, we're charging more due diligence on that. We do charge $750 to $850 for title review as well. It doesn't go to loan docs and title review. That doesn't go to us. That goes to the third party law firm that does our loan docs. We have a few different ones that we use in different areas, but that's not an income stream for us. That gets payable to them. And if it's a commercial deal, typically instead of $1,400, if it's a standard commercial deal, we usually charge $1,500, and that covers, good bit of due diligence. There might be a little bit of a few $100 here and there. So if it is that, sometimes we'll charge a little bit more. Sometimes we'll charge a higher commitment fee, maybe $1,500 or $1,800 instead of $995.
So once we get to a loan is closed and hopefully performing, we'll talk about that first. Like Jason mentioned, we have an 80-20 split between the 10% that goes to the investor and the 2.99 that goes to us as servicing fee. And as you can imagine, that really adds up. And if you're talking about performing loans where they're paying on time, doing their construction work, if it happens to be a rehab deal, they're pretty easy. Performing loans are not a lot of work. And to get 20% of every payment that comes in the door starts to turn into a really nice business model, especially once you get some volume out there. You get 10 million, 20 million, moving on up. Like those numbers get really big. And it's one of the things, like we're going to talk about some other fees too, but it's one of those things that makes me think like this in the world of real estate lending, this is a great model. And there's other, stuff that's outside of what we're describing specifically that I don't love as much. And I'll tell you about a couple of them, then we'll keep going with the fees. If you're talking about brokering deals is okay because it's very low risk and you don't have to underwrite yourself. You don't have to service yourself. But it is a much lower revenue business model, right? There's just a lot of money being made and not all that much of the revenue is going to the broker. Not that there's anything wrong with brokering. Another one is regular conventional mortgage business. Like there's just like very slim margins, and it's real estate lending, but once we moved from like the bank lending world to the private lending world, like we immediately saw how powerful these profit margins are. And another one, frankly, that goes on in the private lending world these days of institutional, like you don't get most of this stuff. Like you're selling the loans off, and I don't know all the back end stuff, but whatever the price is, you're getting a fee up front. May or may not be servicing fee included. I think that might just be built into the fee that they pay you after closing. And then none of the other stuff applies, like not the late fees, not the extension fees we're going to talk about. So for that reason, like, I don't know, like I haven't seen too many models in the lending world better than this one. And there might be some, like you're running a big fund, you got 500 million outstanding, like not really the world that we play in, but still. Anyway, just a little rant on the business model itself. Let's keep going to some of the back end fees. So servicing fee, obviously, if it's performing, you're getting 20% of that. If it goes into default, we change that split. Our default rate in our note is 24%, and that switches to 17% to the investor and 7% to us. About a 70-30 split, because obviously defaults are significantly more work than performing loans. And you could also have some very simple late fees. If people pay past the 5th of the month, we charge a 10% late fee. That can add up too. Like a $2,000 payment, which is, kind of average in this world, is a $200 late fee, and you didn't really have to do anything for it. All they did was pay late. Adds up. Late fees, servicing fees. Oh, then we got extensions. And extensions are very common when you do 12-month loans. You get to the end of a 12-month term. If it's a flip, maybe they just haven't closed yet. Like the property's done, it's on the market, they just haven't sold. It's loan is performing. You check in with them, you see what's going on with the property, with the situation, and you work out an extension fee. You need 90 days. Okay, cool. We'll do 2 points, whatever the case may be. Maybe it's a rental property, some kind of income property, and they just can't get the refi done, which happens all the time with permanent debt, right?
Yep.
So you work out a fee. You need another year. Okay, it's going to be 3 points, 4 points. And they're performing. You're in a fine situation with them. Like nobody really gets mad at that. Sometimes they'll try to dodge the fee conversation on extensions, but for the most part, you just work out a fair deal for both sides.
Well, they recognize that the lender makes their money on the fees and the points as well, and they could be recycling that money into another deal if they wanted to. So nobody really pushes back on that. I think that's kind of expected. I mean, there's lenders in this space that have entrance fees, fees up front and exit fees, and
in commercial lending, that's common.
In commercial lending, that's common. There's big prepayment penalties as well. That's common. So, there's lots of different things. Like in a commercial, if you got a commercial loan, real commercial loan from a bank, they're probably going to have some sort of like waterfall or something prepayment penalty where it's like 5% the first year, 4% the second year, and so on, because they're expecting to achieve a certain rate of return, for doing it. So, there's a lot of different ways that you can structure your fees. I think the most important thing to do is just stay consistent on it. And, maybe if you're starting out and you want to dabble with a few things, feel free. Like, we know a lender who we're good friends with who charges like, 1.5% or 1.875% upfront or as like, the loan every month, like you owe me 1.875%, but then he can tell people he doesn't charge points. You just got to pay 1.875% or 1.5% or whatever it is. Sometimes the way that some of these lenders structure it is, okay, well, you owe me 1% every month as a monthly payment, which in essence is a 12% rate. And then we accrue another 0.5% every month that's paid on the back end, right? Now, some of this stuff might sound confusing, and it kind of is confusing, but like you could do it, like you structure it the way you see fit. If you're in an environment or a market where people are, rate conscious or point conscious, and you rather just structure it the other way, as long as you're achieving your rate of return, so be it. We like to just keep everything very, very simple. We try not to negotiate. This is what it is. Everybody, you do one deal with us, you do 100 deals for us. It's the same exact process. So I would encourage you to just keep it consistent, whatever you see fit, and go with that. And, I also know there's another lender who's in our mastermind group, and she doesn't like charging any quote unquote junk fees. She's like, this is my interest rate. This is my points. You're never going to see anything else on the sheet, on the HUD one. Besides that, nothing else, no inspection fees, no valuation fees, no, doc prep fee. Cause I think she's doing the docs herself or whatever the case is. Point being is be consistent, do it the way you want to, do it the way you want to do it. And you can also determine if you want to share some of this stuff with your co-lenders or not. It's up to you how you want to set it up. The point being is keep it consistent with your borrowers, keep it consistent with your co-lenders of what the proper expectation is.
All right, guys, good deal. That is the pod for today. Thank you for checking out the show. And until next time, we'll see everyone inside hardmoneymastermind.com.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.